In regards to the forbearance,
Yes, sir.
the deferment versus restructuring the loan,
hmm
my interest rate was like 4.25%, and
hmm
restructuring the loan would put a lower interest rate on it. And I was wondering what the difference between restructuring the loan and the deferment, the reason for that.
Okay, so let me tell you this. And this is something that you probably want to see. We've done it in previous shows. Lowering the interest rate actually makes it harder to pay off the loan early. So think of it from the bank's perspective. If you're saving money, James, by a particular financial move, who would have to be losing it?
The bank.
Exactly. Why would they have any program where they're going to be losing money? We're going to show you how lowering your interest rate can actually end up hurting you instead of helping you. Getting a lower interest rate doesn't automatically make things better. What you want to know is what you looked at when you saw your overall financial picture. Here's how much money I borrowed. By the time I pay this back, here's how much I will have paid back. Double. When you see where you're going to go with this thing, then you can say, listen, if that's the case, then what I want to manage is not my payment. What I want to manage is not my interest rate. What I want to manage is my overall cost. What is going to be my overall cost of managing this debt? And can I bring the overall cost down? That's what we need to know. That's where we need to focus, because I'm telling you, banks are making a ton of money because we're not looking at the overall cost of managing the loan. And if I get a refinance, if I get a restructuring, am I lowering my cost or not? And I never know if you end up better by making a financial move. I only know if because we do the math to find out. So whatever the situation you're in, if we lower the interest rate, then you want to know, let's do the math. Let's take it out to the end. Will James be better off with new interest rate and the fees that they're going to put in there to make sure that they get it? Or can we get that new interest rate with no fees? I mean, there are a lot of things that we can do to make sure that you end up managing your debt at a much lower interest cost, James. And we want to do that based on the cost, and don't automatically think because you lower the interest rate that you're going to actually lower the interest cost on a loan. It doesn't necessarily follow. Now, if you look at a 30-year loan and compare it with another 30-year loan, then yeah, it's going to be better if you're comparing two 30-year loans. But guess what, James? My average client is out of debt in 7. So all of the numbers that they're giving you based on a 30-year loan are out the window anyhow. Let's see how we can manage this, get you out of debt in about 7 years. And that's everything you owe, not just the mortgage, but the mortgage, the credit cards, and everything. Let's see how we can get you out of debt between 7 and 9 years on average, and see if lowering their interest rate, if you have a 7-year term as opposed to a 30-year term, let's see how it all works out for you. How's that sound, sir?
Sounds good.
Well, listen,
I appreciate the time.
Thank you for coming to the stage. We appreciate your question. Listen, let's see what we can do to help you out.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.